Hey, this is Sasha, and thanks for joining me here for another video lesson about trading, investing, and the stock market. Now, today we're going to cover a little question that I get quite often regarding options, because especially if you're just getting started in options, it can be a little bit confusing. So we're going to go to the charts and go on screen. But before we do that, I want to make sure you understand that all the examples that we use, since we will be using some real examples, are just strictly for hypothetical and educational purposes. None of this is actually recommendations to buy or sell any stock, security, or option. I think most of you understand that. So the question that we have today is, why would someone sell a put versus buying a call? Doesn't the unlimited downside and limited upside to selling a put make it more risky? Well, let's take a look at the risk factor. When a person is new to trading, they look at the absolute risk in a big picture way. So they're looking at it from a big point of view. But as one gets better at trading, they may look at risks in terms of probabilities or possibilities. So what's the possibility of something happening? So if we look at a little bit more of selling a put versus buying a call, the absolute risk on a bigger picture, of course, selling a put is very risky. However, you can define your risk based on the probability of where you sell that put, which would be the strike price, and how far out you go in terms of time or the month. So if we take a look at this concept on screen, you'll probably get a better idea. So if, again, we just use something for example purposes, and I'm just going to use Facebook here, just to give you a rough idea of where we are on the chart on Facebook, you can see that we're currently right around the $130 range. So let's just take a look here on Facebook. If we go to trading this stock and we go about 57 days out, and I do buying a call, so I buy and then I go to a single, which is off screen right here, and then I right click and analyze the trade. You can see that the risk that I have available on this trade is right here. Okay, so you can see the risk that I have on here is $160. So the way that I can see this is based on the premium that I pay, which is basically right here, $160, or $1.60. Multiply that times 100, because you control 100 shares with one option contracts, and you get your $160 right there at that point. So that's the max risk that you have on this, which would be buying a call. And of course, your direction that you have is to the upside. You have unlimited profit potential, but of course, as we know, what is the chances of that stock getting to 220 in the next 60 days? So, I mean, it's been moving, and here since June, right now we're in September, it moved basically about 10-15 points, give or take. So the probability or the possibility to hit 220 is not really likely or realistic, but of course anything could happen in the market. But in general, you're risking $160 to potentially make whatever it is. It could be $3,000 in the 170, 155 in the at the 155 region, you're making about 1480. Or 145, 660. I think it's more realistic to look at 140, which would be about $360, and that's without time decay. So the thing about buying an option, anytime you're buying an option, and I'm looking at this right here, if you're buying an option, anytime you have that, you have this thing called a theta, and there's our theta right there, in which case every day that option premium decays $3.26. Now, as we approach a little bit closer into this range right here, so let's just say we move this hypothetical line, you can see that theta actually increases to $4.58. So that decay, as we increase the data as well, continues to accelerate. So you can see more and more you're losing money every day. So if you're a rookie trader, you're just getting started, the general thing that happens here is that if you're just getting started in trading, putting on a position like this is you're losing money every day. Just think about it. You're putting on a position and you're going to lose money every day. Whereas if I look at it the other way, let's just analyze the trade. We're going to go to a put, and the put that we're going to do if we take a look at it, let's just say it's a 110 put, okay? So I go to the 110 range. Keep in mind the stock's current price is right around 130, okay, 130.17. And now we're actually going to go and sell this put. Now, the thing is with this stock is it appears like it will, you have unlimited loss. Really, your loss is actually only if the stock gets to zero. So in this case, if you're selling a put, you're looking at right around $10,000, okay? Actually, let me see here. Let's make it a live price. Yeah, right around $10,000. So here, the thing is there's a few big differences. You still have profit potential to the upside, okay? So you're still profitable to the upside, but your decay, your option premium now, as you look at it, is actually a positive $2.12. So that way, if the stock doesn't move at all, you actually make money. You make $2.12, and that actually continues to accelerate day in and day out as those days continue to move forward. So you can see, you make $1.90, $1.88. So you just continue to make money every single day that stock just stands still. Whereas if we buy a single, you're losing money every day. Now, yes, you have unlimited profit potential, whereas on selling a put, you don't have unlimited profit potential. You're making your $63. Of course, I could tighten this up to, let's say, 115, and now it would be a bit more. It's based on what I'm selling, just like a business. Business makes money by selling things. So here, we're selling something at $1.09, giving me $109, but you also have, if it stands still, you're making money. So looking at these scenarios, here's what happens. If I buy a single, I lose money if the stock stands still. If it goes against me, I lose money. If it goes up, I still lose money on a day-to-day basis, but I do have unlimited profits. It really needs to get past this 141 break-even point, which you can see right there indicated by that little hash mark right there, in order for me to break even at expiration. Otherwise, you're losing money day in and day out. But it does look nicer in terms of, yes, unlimited profit potential. So those are some of the risks. Here, you do have some unlimited risk if the stock goes to 80, but what is the chance of that happening? The possibility or the probability. So for it to get to 80 in the last few months, what were the chances? If we take a look at, let's say, the weekly chart, down at 80, it would be at multi-year lows. So it would basically be a major sell-off. Is it possible? Absolutely. So what do most traders typically do? Well, the professionals will still typically sell the premium. But if you're worried about compensating for that unlimited risk, what you could do is, let me just share with you, this is called a vertical. You would sell that 120. Okay, and what you would do is buy a put. Let's just analyze the trade. And now we would buy a put somewhere at, let's say, 115, capitalizing on the net difference. And now I cap my losses right here at $421. So the max I'm risking is $421, but I'm making about $80. So it's looking, give or take about, let's just say, 15, 18%, 14% on my investment. So it's not quite 25% because that would be a quarter. But in general, now the stock can stand still. It can move up. It can pull back a little bit, and you're still profitable, and you'd make your $80. In the other situation right here, the stock needs to move for you to make money. If it stands still, you're at a loss. If it goes up, you're still at a loss unless it goes up within the next few days. Otherwise, you're losing money every day. Whereas in this scenario and situation, now all of a sudden, since you're a net seller, if the stock stands still, you make money. If it goes up, it makes money. If it goes down a little bit, you make money. The scenario where you lose money is if it goes down quite a lot in a shorter period of time. So that's typically why, in general, most people are sellers, because just like a business, you typically want to sell products and items. So I hope that makes a little more sense when looking at it on a profit loss picture. The software that I used, by the way, on this was the Thinkorswim platform. So you can take a look at that, or there's other option trading software that'll give you profit and loss analysis pictures. But in general, most traders, as far as ones that are more active, are looking to sell option premium. Just like a business, you typically want to sell products. You want to be a net seller, and then you buy a little protection there to hedge for those losses. Now, as far as a rookie beginner, if you're just getting started, yes, thinking about it in terms of I'm only risking $100 and my theta is only $2. It doesn't sound like a lot, but imagine putting on 5 or 10 or 50 of those trades consistently, and then you're losing on them day in and day out. Every day you're just losing money. That's like basically taking out your wallet, and you take your money, whatever it is, and then you're just, boom, here's a loss, here's another loss, and then here's another loss, and then there's another loss. You're just constantly throwing and losing money all the time on these option contracts, and that's not what you want to do. You want to instead collect that money. So here's your cash, here's your cash, here's another cash, right? So you're collecting money by selling premium. That's what you want to do. Thanks for joining me in this video. If you enjoyed this video and you want to see more videos like this one, go ahead and take a look at my website, investinghelpdesk.com or tradersfly.com. If you want to see a list of the books that I have, check out this link right here. And if you want to continue watching some more training and educational videos, then take a look at this link right here. So there's some options for you. In the end, remember, there's more to life than just money. Go out, do what you love, contribute to other people, but most importantly, live life abundantly.